Hello, and welcome to the Joss Brown Podcast. With over 40 years of combined financial planning experience, we will discuss our favorite topics, concepts, and stories. Hello, welcome back to the Joss Brown Podcast. I'm Devin Joss.
I'm Dan.
And I'm Philip.
And today we will be discussing rebalancing, what it is, the pros and cons, and just going over it as a whole. So, Philip, you want to say what it is?
Yeah, so we just wanted to discuss a little more about rebalancing and why we do it and why we do it in our clients' accounts and kind of how that works. And so,
What is rebalancing?
What is rebalancing? Well, that would be bringing a client's allocation, so stock to bond ratio, back to what it's designed to be. So if that's 60-40, if that's the desired portfolio and it's gotten up to 80-20, then we want to dial that stock back a little bit and bring it back to what it's supposed to look like.
How does it typically get out of proportion?
Stock market, yeah.
Or bond market?
Typically,
Maybe.
the stock market.
Yeah.
It's usually the stock market's the culprit, yeah. Whether that's the ups or the downs, it's usually the stock market that's moving. But the big thing for rebalancing, the purpose we do it is for risk.
Okay.
And so we want to make sure that our clients' accounts are ready for whatever their future might hold. And so, if they need cash withdrawals, we want to make sure that they have the right amount of safe securities in there. Or if they want that growth in their portfolio, we want to make sure that they have the right amount of growthy stock in there.
Mm-hmm.
And so
if
positioned
we
for that.
were at 60-40, well, first let me say we probably never let a 60-40 go to 80%.
Yeah.
But if we were at 60-40 and time went by and we're 65-35, then the portfolio is riskier than it was when it was 60-40.
Yep.
So we would want to trim the part that is above 60 back to 60 and build back the 35 up to the 40.
Yeah.
And we have some, well, that's in essence why we do it. So to make the portfolio at the risk we want it to be at.
That's right.
Yeah.
Yeah. And something else it helps with is in volatile markets, you can sell high and buy low. And so it's another opportunity to kind of buy the dip in hopes that it'll return.
How often do we look at rebalancing? Is each client different? Do some have a trigger at like certain percentage, or how does that work?
Yeah, there's two ways to look at it. One is time-based, and so, some advisors will rebalance quarterly or semi-annually or annually, and the other is kind of balance-based, and so you set a percentage target, and then if it goes over 5% or so of that target, then you sell back to the target. And even there's some advisors that don't sell back to the target, but sell back to within the boundary. And so there's a lot of ways to do it. The way we do it is the bounds method, and so once a certain allocation gets out of bounds enough, we sell back down, or if it's below, we buy more of that security.
And we may not have to do that. That sounds a little mechanical, but as clients who are pre-retirees and adding to their portfolio, we're adding to those positions that are under target without effectively totally rebalancing the portfolio.
Yeah.
And for the retirees that are pulling out of the portfolio, we're trimming what's done well and it's above target to get them closer to back to target without having to need to rebalance.
That's right. That's right. And then there's also the taxable considerations as well. And so if it's gonna induce a large taxable gain, then we may choose to let it ride until next year, until the client has lower income or what have you. But that's consideration. We may decide to take the tax hit, but that's something we consider.
Yeah, and I don't like to let the tax tail wag the dog, because markets will be markets, and like Philip said, if it's out of balance, it could be riskier than the client can handle.
Yeah.
So it's certainly worth conversations with the clients. But we're continuously monitoring these portfolios, so we know how much we're off target, even though we may be well within the balance.
Are there certain strategies that we use when rebalancing? I know we've brought up tax loss harvesting in the past. Is that something that we consider?
Tax loss harvesting, we typically look at that as we're rebalancing, but it's a separate piece that can be done separate and apart from rebalancing.
Okay.
Yeah, and then there's also a swap feature as well. If for some reason we're getting rid of a fund completely and switching to another fund, the nice thing about that swap feature is that you don't have to spend a day out of the market. You can swap it overnight, and then the next day you're holding that new security. So it's kind of beneficial to the client as well.
And typically we look at all of those things when we're particularly when we're meeting with clients.
Mhm.
Here's what's happened, here's why it's happened.
Yeah.
This is a new recommendation for you if and when you do that.
Mm-hmm.
Here's what it will be replacing in the portfolio. If there's tax consequences with this change, here's what those are. And here's how we're rebalancing the portfolio altogether.
Yeah.
Yeah, I think the biggest thing about it is just being consistent and being diligent to stick with the model you originally set.
Yeah,
So,
my dad used to have for a period of time, his advisor was doing automatic rebalancings,
Mm.
like daily. And it was, in my opinion, a little too much,
Mm.
but it's possible, because it's costly. I mean, there's a consequence to rebalancing. And that's what we talk with our clients about is those pros and cons of rebalancing and the consequences and all that goes with that.
Yeah.
And so he was doing daily. Philip, you mentioned monthly or quarterly or some annually rebalancing. The bottom line is, like Nike, just do it. Just rebalance. And that's part of the psychology of investment is we don't want to buy what's just lost 20%. Like, I don't want that. It's like, but the long-term benefits of rebalancing and buying low, trimming what's outperformed recently and adding to what's underperformed recently benefits us in the long run.
yeah, and that's why you set that allocation at the beginning, because you're hoping that not just this stock or this fund will do well, but all of them will do well over time. And
Right.
so as you rebalance, you position yourself for that.
And what we do a little more specifically than 60% equity is we have allocations to large company stocks and small company stocks and international stocks and emerging market stocks and other things. And those all do well over time, but at different times.
Yeah.
And that's where the rebalancing, even within the 60% equity, adds value to the portfolio and reduces the risk of even just the equity portion.
Since we're talking about rebalancing, we did this CFP episode. I was just wondering, for psychology, do you ever see clients not want to rebalance? If they see the stocks going up, they don't want to, they will either buy high and sell low? Or what is it?
Philip, what's your
Anything about that?
Absolutely. Usually,
You made that sound pretty sure of that. Have you had a lot of?
well, I've been doing it for 2 years, so I've got a lot of experience under my belt.
Yeah.
It seems to me, well, even in my own experience, over the past 10 years, the S&P 500 has outperformed, I think, everything in the market pretty much. And so, or at least it's been a top performer,
Yeah.
I'll say that. And so it's hard not to.
5 companies in the S&P 500 outperformed.
Yeah, exactly. Yeah. It's hard not to just, move all of your money to the S&P 500 in hopes that it will continue that trend. But if you look back over history, many different stocks have done that, have outperformed over years.
2000 to 2010, the S&P 500 ended where it started, where it lost 40% in the first 3 years, and then it lost another 40% in 07, 8, and 9.
Wow.
The small cap stocks were outperformed large that decade, and real estate outperformed large company stocks that decade. Since then, large has outperformed small this next decade. And this year, or this decade from 2020 to 23, it's been a little mixed bag of everything.
Yeah.
And I just remember this specifically because it was 2008 when lots of things dropped in value. The S&P 500 dropped 40%. Bonds were flat. At least the bonds we invested in were flat. Some were negative. There was 3 responses to a normal rebalancing meeting.
Mhm.
One was, yep, we get it. it'll come back and we know what you're doing. Thanks for doing this. Another one was, I understand theoretically what you want to do, but I don't want to do it yet. And so that part of the conversation said, we'll look at this in 3 months and we'll talk to you again. But we know that it is hard to buy low, particularly a 40% decline. And what clients were experiencing, if we were talking about a 60-40 portfolio, is if the market's lost 40%, their portfolio lost 24%. And so I don't want to sell my bonds that are relatively safe to buy equity that has lost 40%. Well, 40% by the end of March, but we were down 30% for sure. And so we left it, and then we revisit it in the following months to rebalance. The third response was, I can't handle this. I need to reduce my allocation to equity so that I don't lose any more. We had one client do that, and they were successful. They didn't lose any more, but then they have the regret when they see this market start going back up that they're not part of that. And the people that waited and didn't want to rebalance started to tell, we get it. The world isn't over, and people continue to buy things, and capital markets continue to work. So let's rebalance, and they benefited. And the ones that benefited the most were those that just stuck to the discipline of, like I said earlier, just doing it, just rebalance.
Yeah, so our job as advisors and fiduciaries, I guess, is to, and our value adding to our clients is to rebalance, to make sure they're on a straight path, the portfolio that they started with, because everyone has different investing goals and needs.
Keep a look at the long term. Markets will go up and down, and the equity premium is received or got by those people that put up with the volatility in the markets.
Yeah, and also it's not as important what you're invested in as it is how much you're putting into your investments. And so don't worry too much about all of that, but worry about adding to those portfolios, I'd say.
Well, I think our clients are a little more educated. They know what's in their portfolio. They know our discipline of how we invest and why we invest, and they stay in the markets.
Yeah.
All right, well, thank you for joining us today, and hopefully you learned a little something about rebalancing, and we hope to see you next episode.